Good morning, everyone. Thank you for joining us. We'll get started in about 2 minutes. Good morning, everyone. Thank you for joining us this morning. I'm Ava Wadome. I'm the Membership and Strategic Partnerships Lead at AmCham Kenya. Welcome to this webinar where we will be unpacking the Finance Bill 2023-2024, brought to you by the members of the AmCham Tax Task Force. So the purpose of the session today is to unpack Kenya's Finance Bill, shining a light on the overall economic and business impact, as well as getting into the detail of the proposed tax measures and their immediate implications on your business. We have a fantastic lineup of speakers and experts, speakers who are experts today. We have Alice Muridhi, who is the Associate Director, Tax and Transfer Pricing at PwC. We have Patrick Chege, Associate Director, Tax, Deloitte East Africa. We have Kivindio Munyao, Senior Associate at OK Law. We have Kenneth Njuguna, Partner at ALN Kenya, Anjawala and Kana. We also have Ken Gishinga, Founder and Chief Economist at Mentoria Economics. The session today will be moderated and facilitated by Lydia Abala, who is a regulatory lead and tax regulatory lead for tax regulatory services at KPMG. So we really thank our panel of experts for your time and expertise and sharing your expertise in this session today. The program will begin with painting a big picture view of the finance bill, touching on the economic outlook and what we can expect and what the implications are on the economy. We'll then follow this with a detailed panel discussion, unpacking the proposed tax measures in the bill and, more importantly, what the immediate implications are. Please feel free to engage throughout the session. Post your questions in the Q&A tab. You can chat in the chat, but put your questions in the Q&A, and we will respond to all the questions as much as time is allowing. However, in case there are any questions that we haven't addressed by the end of the session, we will provide written responses as we share the recording of this session. So with that, I would like to welcome Lydia to take us through the rest of the program. And as you start with that, please go ahead and introduce yourself. Thank you.
Thank you so much, Eva, and a very good morning to everyone. It's indeed a very beautiful morning here in Nairobi, and the weather is just perfect to speak finance bill and get ahead of the game. My name is Lydia Abala, and it's my absolute pleasure today to moderate this super panel. Indeed, there's a breadth of wealth of expertise on this stage, as has been alluded to by Eva. And personally, for me, it's been an amazing 1 week with the presentation of the finance bill before Parliament. And it has given me a lot to think about. And I'm really, really excited to hear from my colleagues today, their views and how this affects us. Without further ado, I would also like to extend a very warm welcome to our panel of experts today. And maybe to start us off today, I'll ask them to introduce themselves and maybe in a sentence or two, share with us what stood out for them the most about this bill that we are about to speak to in the next hour or so. So I'll start with you, Ken. You can put your video on and introduce yourself.
Many thanks, Lydia. Indeed, good morning to everybody here. My name is Ken Gishinga, and I'm the Chief Economist at Mentoria Economics. Our work really is to provide strategic advice on the state of the economy to clients. Every Monday morning, we publish a global markets report, which I would encourage you to subscribe. And my background is in economics. I have a big passion for business. My research at Harvard was really on Joseph Schumpeter. This is the fellow who coined the word entrepreneur. So I have a big passion for business and for enterprise. When I look at the Finance Bill 2023, for me, I have a sense of concern because for me, it doesn't drive production. What Kenya badly needs is to move into production mode. And I think it's going to raise the cost of living. I think for me, the VAT on fuel, doubling it to 16% for me is my biggest concern. Many thanks.
Thank you, Ken. And I guess you're just setting the stage to unpack and hear more about that. The VAT on fuel certainly affects everyone on this call. I'll move to you, Patrick. Please introduce yourself.
Good morning, everyone. I'm Patrick Chege, an Associate Director at Deloitte East Africa. I mainly deal with tax controversies, that is dispute and related areas. In terms of professional qualification, I'm a lawyer, an accountant, and also an economist. And I've also been a teacher for many years. 15, 16, 17 years of teaching. And therefore, the area of tax for me is my passion. Now, what has stood out in this budget is basically the fact that everybody has been hit very, very hard. And even as we say that, we feel it more for the lower segment of the society, where the incidence of tax appear to settle. So we are very, very concerned about this budget. Thanks, Lydia.
Thank you, Patrick. I'll move on to Mr. Kivindio Munyao.
Thank you, Lydia. Good morning, everyone. My name is Kivindio Munyao. I'm an associate at Triple OK Law Advocate, mainly dealing with issues to do with tax controversies and tax disputes. My background mainly is law, and I'm an advocate with the High Court of Kenya. I also double up to a training in terms of CPA, a bit of accounting here and there, to enable me to appreciate the entire context of tax. Now, what stood out for me, Lydia, in respect to the current Finance Bill 2024 is the trial by the government to try and expand the tax base, mainly touching on the issue of digital assets as well as digital content creators, which is a good trial, and also appreciating that there's need to integrate the international standards such as the mutual assistance agreements, which are required to the purview of Kenya, while we're appreciating the international tax. On the downside, I really have an issue in regards to the question of trying to impose a particular rate in respect to matters which are moving from TAT to the High Court. Maybe as we move along, we can be able to discuss on other highlights and downlights in respect to the Finance Bill. Thank you, Lydia.
Most certainly. Thank you, Kivindio. I'll now move on and ask Kenneth to introduce himself.
Thank you, Lydia, and good morning, everyone. My name is Ken Juguna. I'm a tax lawyer and a partner at Anjawale and Advocates. I advise on all aspects of Kenyan tax and also represent clients on disputes against the Revenue Authority. I must say this finance bill has been quite brave. Lots of changes across all taxes. Lots of noise has been made. But what stands out to me is the lack of consistency from a policy perspective. For many of you who have been in the tax market for a while, you'll know that there are some changes which have been introduced in the past. They have been withdrawn, some have been shelved, but we're still seeing some of these changes being reintroduced. Of course, we do hope that government will make good its promise of putting in place the Kenyan tax policy so that businesses can have more certainty in terms of tax legislation. I'm sure we'll touch on that more in this discussion. Thank you.
Thank you, Kenneth. Last but not least, I'll ask you, Alice, to introduce yourself.
Thank you, Lydia. My name is Alice Mureithi. I'm an associate director with PwC Kenya. My core areas of specialization are international tax and transfer pricing. And I'm really glad to be here this morning to try and unpack the Finance Bill 2023. I think what stood out for me was really the government's commitment to continue to mobilize tax revenue. And I think there are three main ways that they're trying to do that. To expand the tax base by recruiting new taxpayers. For example, we have the digital asset tax, which is a new concept. There's an increase in the rate of VAT on fuel from 8% to 16%, as mentioned by Ken. The government is also trying to deepen the taxes, the tax environment, and this is really collecting more taxes from the already existing taxpayers. So for example, there's an incremental pay as you earn on the top income earners. And the government now wants to collect taxes on a real-time basis, to improve its cash flow. So for example, proposals for withholding taxes that are due from residents to be collected within 24 hours. So really, that's really what stood out for me, the government's very firm commitment to mobilize our tax revenue and reduce the fiscal deficit we are facing. Thanks, Lydia.
Thank you, Alice. Thank you so much, everyone. And I'd like to welcome everyone once again to this session. It looks like we are certainly in good company with lawyers who are also accountants. My background personally is that I'm also an advocate of the High Court and an accountant as well, and a member of the Law Society of Kenya. At KPMG, I take care of the regulatory service line of the business. I do all the fun stuff, the legal audit, legal due diligence, restructuring, insolvency, only the fun stuff. So sounds like I'm in really, really good company here. And I can't wait like everyone else to hear what our panel of experts have for us today. Just diving deep into it and picking up from where Ken left off in terms of the outlook of the economy and what this means to us, Ken. From a global economic outlook perspective, what are some of the concerns in the near and medium term based on what we have experienced in the last 2 or 3 years, and bringing it closer home to the concerns you alluded to when you were introducing yourselves? What do you see as the major concerns, not only unique for Kenya, but from a global economic outlook perspective? If you could speak to us about that.
Many thanks, Lydia. Indeed, the global economy is facing a significant slowdown. Inflation has been a problem globally. In the United States, it remains very high and sticky. If you look at the United States, the numbers that came out this week are about 4.9%. So still very high, although it's coming down. The Fed has been very aggressive in raising interest rates. Right now, we're having the highest interest rates in the last 16 years. And obviously, that has led to a slowdown of the American economy, which is an engine of the global economy. Obviously, that has made the dollar rally. Investors like it when interest rates go up on their currencies. And that's also driven to what we've seen in Kenya, where we've seen capital flight from currencies here in Africa, Kenya shilling, the Naira, going back to the United States. So it's a time from the American perspective, it's a very slow period. And there's also the additional problem of the debt ceiling. Right now, the US faces a default if they don't have a major agreement on raising the US debt ceiling by the end of this month. So that's a big event that might actually affect global events. In Europe, we are seeing again inflation. Again, I think the UK is the worst hit. Inflation there, it's in double digits. Obviously, the Bank of England has been very aggressive in raising interest rates, the highest it's been since 2008. And I think they say that they'll continue doing so until inflation comes to around about the traditional 3%. Obviously, that has affected the UK economy in terms of recession prospects, but also the broader Europe, the concerns around the geopolitics, the Russia and the Ukraine. A lot of people ask, what's the outlook on Russia, Ukraine? And from my perspective, when I look at the moves that are being made in Russia, Ukraine, particularly in Ukraine, with the arrival of those new Patriots from the United States, these are by far the most aggressive weapons, really. So it tells me that that conflict is far from over. If anything, it's about to get into its worst possibly phase. So it means even things like wheat prices will be affected. Russia and Ukraine are big producers of wheat, and we've seen wheat prices go up quite a bit. Here in Kenya, 95% of our wheat is imported. We only produce 5%. So that will definitely be felt from an inflation perspective here in Kenya. China has been considered to be hopefully the growth spot for Africa, for the world. And, because of coming out from that zero COVID situation, the first quarter numbers were very encouraging, about 4.4% in the first quarter. So we were getting very excited about China being able to drive global growth when the rest are slowing down. In fact, they say China and India would account for 80% of global growth. But the numbers of late have been disappointing. If you look at the numbers that came out this week, imports and exports are down. So I think even that growth story has been overstated. So China might also be facing a slowdown. I think Japan is a unique case. Japan remains the only bank in the developed world that has not raised interest rates. So things there seems to be moving a bit fairly normal, but the global story is quite on a slowdown. When you come to Africa, I think the debt situation has been the worst, the big issue. 19 out of 35 sub-Saharan African countries are facing major debt distress. And this has been tied to what I said earlier about the currencies. Really, currencies have weakened significantly. And most of these African countries have external debt. And that external debt has been in dollars. So anytime the currency slips by a bit, you find the debt becomes quite big. So IMF is doing a lot of work with the Ghana, with Zambia, Nigeria. Obviously, South Africa is has significant power outages. They've had power outages every single day for this year, and it's hard to see a solution to China. So it means East Africa needs to be the hope for the continent. When you come to Kenya, and my hope had been Kenya should be the growth engine for this region. But when I looked at the Finance Bill 2023, it contrasted with the hustler narrative that was pushed back. Because when I think about the hustler, I think about the person at the very bottom trying to make production easier. But for me, my perspective, increasing the cost of production, fuel. In economics, we talk about the 4 factors of production: land, labor, capital, and enterprise. And I've not seen quite a bit of any serious engagement on that. When I look at the turnover tax, for me, it's a worry, because when I think of really the margins that a lot of these small businesses have, many of them have margins as narrow as 5%. So when you add 3% tax on that, it takes away from that. So for me, I think it's a sense of concern. I think Kenya still remains a good place to invest overall. I think the things that make Kenya a good place to invest is really, we have a young labor force. Our median age is 19 years. We have a well-diversified economy. We don't depend on any particular mineral or one particular sector. We are diversified and we have good infrastructure. But we desperately need to get this country back into production mode to create jobs. The labor market is still very, very untied, with about 3 million people still being unemployed.
Yeah, thanks, Ken. And I think you've alluded to the question in most of Kenyans' minds today. How have these variables that you've spoken to, the slowdown growth in China and the US, which is very concerning, contributed to Kenya's macroeconomic environment today? And are these things only unique to Kenya? And from what you say, certainly not. But your main concern, as I understand it, is what is the government's reaction to this? And maybe connected to that, is it fair to say that the Finance Bill 2023 is a reaction by the government to address some of the issues you've spoken to? And do you have any confidence in that bill, if passed into law, ability to turn around the country's macroeconomic situation in the next maybe 1 year?
Well, you're right. There have been some exogenous factors that are affecting Kenya, like for example, the currency part. The Kenya shilling are losing value against the dollar. You know, Kenya is a net importer. So definitely when the currency slides, we feel the heat, and importers feel it more while exporters are on the happy side. But I think for me, when I think about what's happening in Kenya right now, the Kenya Kwanza administration had a grand agenda of stimulating production at the very bottom of the pyramid. The challenge is the IMF also is trying to rein in fiscal deficits, and it has its dictates. So we are walking between a rock and a hard place where we want to create jobs, but the IMF has been very keen on Kenya's budget deficit coming down from 6% to 5%. So I think the government is trying, given that it needs the loans from IMF right now, I think it has to follow the path that the IMF dictates. But I think once this program, this is a 38-month program, I think we are in month 19, 20, we still have maybe a year to go. I think we now start to ask ourselves, once we are done with this IMF program, how do we start creating jobs in this country? How do we start growing the economy? So it's, yes, you could say that there are some exogenous factors, but also there is some work that the government needs to do.
Yeah, yeah. In your view, what should come first? Should the government collect taxes to enable us for development, or should they put in development and put food in people's tables and money in circulation, then collect taxes? To me, it sounds like a more chicken and egg situation, but I'd be interested to hear your thoughts in view of the government's 5 focus areas and what the Kenya Kwanza government promised the entrepreneurs and the Kenyan person when they were coming into power in terms of agricultural transformation. Should they transform us, then tax us, or tax first, then finance the transformation? What's your view on that?
I think those two questions are absolutely connected. We do need a tax policy in this country. And I think it's something that I've written about quite frequently. We certainly do need a tax policy. And when I say a tax policy, I think our focus a lot has been on tax sustainability, but we do need what is called a progressive tax system. A progressive tax system really that is not very embedded on, very heavy on consumption taxes. Our system of tax collection is very heavy on consumption taxes. VAT, excise tax. The problem with those taxes, when you overdo them, they create several problems. Number one, they create the cost of living issue that we have, because you have to add 16% everything. They slow down business because things become very expensive for people, and they disencourage investments, and that's a problem. I think we need to broaden our thinking in terms of tax policy. I've always said, you know, sectors such as real estate, when you talk about land rates, for example, land rates in Kenya are extremely low. It's about 0.015%, I think, here in Nairobi. It contributes very little to the economy. If you go to any major global city, London, New York, Tokyo, land rates tend to be at around 1%. So I think we are not capturing the revenue in the right way, and that needs to be the revenue. I think every time we burden people with VATs on salt, on your food, on anything, it makes life very difficult. So I think it's moving towards a progressive tax system that really creates revenue. I think once you do that, people start, now we have to talk about the factors of production. Are we doing enough work on the 4 factors of production? Land, you know, you go to the registry right now, Lydia, you'll be told the last 3 years, you could not conduct any transaction here in Nairobi. They are trying to digitize the process, but that process has been very slow. Yet land is a key part. So you can imagine the lost mortgages, the lost businesses that are coming up. So I think we need to digitize all these factors of production, land, labor, capital, and enterprise. for us to really be able to get this economy to a good growth rate.
You're right, Ken. And I'm sure it's not all doom and gloom with this bill, as it may sound maybe at this point. What are some of the wins that you could say are there for the Kenyan taxpayer or an investor today, should this bill be passed into law? What are some of the wins that you see?
For me, I think on the LPG, I think that was welcome, exempting it. Although I think people need to understand the difference between exempting and zero rating.
Yeah.
I don't think a lot of the population understands that. But there is, on the energy side, there is that intention to reduce the cost of energy broadly. I think for me, that is really, I think, what gave me some source of encouragement.
Yeah. Okay. Thank you. Thank you so much for just setting the scene for us and giving that high level global economic outlook and even speaking to the macro economic situation here in Kenya. And you so aptly put it that the government needs to strike a balance and have a progressive tax policy that is not only funding the glass balls, if you ask me, funding the debt, but also putting, empowering its people and also delivering in its agenda. So it's a delicate balance. And I'd be interested, as we now delve deeper into the various taxes, to hear what are these reductions in tax or introduction of new taxes, as had been spoken to when we were introducing ourselves, and how do those affect our businesses, and how can we prepare for these and get ahead of the game, and certainly not be caught flat-footed after 30th June when this is passed into law. Thank you very much, Ken. I think I will now request the other panelists to put on their videos as we delve deeper into the various taxes. We will go straight away to corporation tax. And I think for this, I'll start with you, Patrick. From my reading of the bill, I see there's a proposed reduction in branch income tax from the current 37.5% to 30%. At the face of it, and to me, this is a welcome move. But within the same breath, I also noticed that the bill proposes to introduce an additional tax on repatriation of profits by the same branches or permanent establishments, if you like, which was not previously provided for. So is it a double-edged sword? Is it something to be celebrated? And I also noticed that the taxation of the profits that is being introduced has not been explained, or the rates applicable have not been prescribed. What do you think this would look like? And do you think this is a welcome move, or it's just taking money from this pocket and then putting it on the other pocket for the taxpayer?
Yeah, thank you, Lydia, and the audience. I think this is a very, very interesting question because it touches on a business formation that is not very familiar with many Kenyans who incorporate, companies here. Maybe just for the sake of the audience, I would want to explain what a branch is. When we talk of a branch, we talk about the activities of a foreign incorporated company in Kenya. What this means is that if a company is, for instance, incorporated in the UK and has some business presence in Kenya, it doesn't have to be incorporated. All what is required is establish the business, obtain a certificate of compliance, and then there you go. Now, in terms of the law, they're subjected to a very specific legal regime because in terms of income tax, what we call corporation tax rates, they are subjected to other 7.5% on profit. Now, if you compare that with a local incorporated company, maybe the same UK company deciding, yeah, let's incorporate a subsidiary of the UK company in Kenya, then that subsidiary will be taxable at 30%. Now, the controversy here is that when you tax the profit of a branch at 30%, and the branch, of the subsidiary 30%, and the subsidiary again distributes dividends, the dividends are also subjected to a 15% withholding tax. Now, if you consider the 15% on the balance of the retained earnings as a percentage of the total income, then it works to about 10.5%. So in absolute terms, you have a locally incorporated company being taxed at 40.5%, which basically is higher than the corporation tax rate for a branch, which is at 7.5%. So of course now there are concerns because the argument was that you are advantaging, the foreign company which is not incorporated, yet they're operating the same environment, enjoying the same infrastructure, the same security, the same everything, and it was seen like there's no parity between the two. And therefore, the government, of course, and the KRA decided these two must be harmonized. And the first attempt was made in 2018 through the income tax bill. There was a proposal to harmonize the two, and that did not see the light of the day. Again, the proposal came through the tax policy. The proposed tax, policy, the one that we dealt with recently, and again, there the issue was it wasn't clear what rate is going to be put. So when we were submitting before Treasury, we made a case that if you have to tax repatriated profit by the branch, then you must lower the rate of corporation tax. Otherwise, you are going to create another imbalance. If you are to tax, branches at the 7%, and then impose maybe a 15% withholding tax, then again, it will create an imbalance because the effective tax rate of the branch will increase to almost like 50%. So I want to believe that this finance bill is trying to balance the two, but the way they are trying to do it, they have taken the first step by lowering the corporation tax rate to 30%, but the rate of withholding tax on the so-called repatriated profit has not been fixed. So we can't tell the direction as of now that this one is going to take, because that rate should be worked in a way that it doesn't disadvantage the branch. So basically, yes, as of now, we can see it's a double-edged law, because it has the benefit of reducing the rate of corporation tax rate, but we are yet to make a firm conclusion until we see the rate of withholding tax. So basically, maybe that's the first part of your comment, Lydia. And basically the second part of it, so as the law starts now, I've said an incorporated company will be taxable at 40.5%. That is 30% and 10.5% withholding tax, vis-a-vis the 30% in the proposed bill, for the branch. So obviously, when the rate or withholding tax is finally enacted, then we see what direction it takes. But apart from the rate, I think there are many other concerns that should also be taken into account because as the law starts now, there are a lot of prohibitions in terms of expenses that are allowable to a branch. So much as a lot of people may concentrate on the rate, they may lose the debate, because when you go back to the Section 18, Section 18.4, Section 18.5 of the Income Tax Act, a lot of expenses that are ordinarily allowable for business and will be deductible by a subsidiary are not allowable against the income of a branch. Now, if that is allowed to remain, then it means that branches are going to be greatly disadvantaged. For instance, if a director of the foreign company renders services, those services, the cost of that service is not deductible, especially where the directors control more than 5% of the income of that foreign company. And even where they don't control 5%, again, there's a cap to 150,000. So it means a lot of genuinely incurred expenses will be lost. Now, besides that, there are specific and strict prohibition, again, in terms of the general administration cost, which is a very wide category of cost. Those are specifically prohibited under the law. And not only that, a branch is not allowed to deduct expenses in the nature of royalty, interest, management and professional fee, foreign exchange losses, which are very, very critical, expenses of the business. So therefore, what it means is that if we have to, arrive at an equitable rate, then we must also repeal these sections of the law that bars, branches to claim these expenses. I know currently where there is a double tax agreement, these expenses are allowable. But if you look at the Kenya's double taxation network, it is still very narrow. We are still under 20 in terms of the DTs that are enforced, and therefore it means that a lot of corporations from other countries will not be able to enjoy, the deduction. Yeah, but what has been proposed under the bill is that the bill has proposed a formula on how to arrive at the repatriated profit. And this is a very, very simplistic way, because they have taken the opening asset, a net asset, and the closing net asset. And therefore, they are looking at this as balances at the beginning of the year and at the end of the year. And then, of course, adjusted by the profit for the year and net of tax. What does this mean? It means that several things must be noted. Number one, that the profits are supposed to be determined in accordance with the generally accepted accounting principles. Now, if you look at what this means is that all expenses that are allowable and for accounting purposes should be allowable for tax. And then it means that all these sections, section 18.4, 18.5, then becomes redundant. But until they are wiped out, until they're removed from the act, then it means that that is law that is in force. And therefore it means we need to do something to ensure that our taxpayers are not caught up by this messy sections of the law. Then besides that, as you know, Income Tax Act provides for accelerated capital allowance. For instance, I could give an example. If a branch is a manufacturer, it may enjoy 100% accelerated rate of depreciation or capital allowance. Now, that can be contrasted with the general rates that are applicable under the accounting, which is normally 10%, 20%. What it means is that if you determine tax based on the generally accepted accounting principles, then it means that you lose it in terms of accelerated capital allowance, and therefore you'll be taxing the branch earlier than you should have taxed. Then I think this is an area that must be looked at and harmonized before this law comes into being. And possibly an extended discussion may also touch on the anti-avoidance provision of Section 24, because currently for branches, when they fail to distribute dividends, there is an anti-avoidance provision where the commissioner, and usually of late, commissioner has been invoking this particular provision, where a company is forced or deemed to have declared dividends, and a withholding tax of 15% is applied. So there's a possibility that this may also now cover branches. such that when you fail to distribute dividends, then you are forced by Section 24 to declare dividends. So all that I think should come before this law comes into being. Lydia?
Yeah, thanks, Patrick. And you bring some very interesting perspective on just sharing the background on what motivated this change from the perspective of Kenyan businesses operating under the business form of a subsidiary. But on the flip side, there's also the investors. Do you think this is likely to de-incentivize foreign investments by companies who do not want a more permanent form of a business and they prefer branches? Do you think this is likely to de-incentivize? And I have taken note of the various comments you made around the proposed changes may not work as they are without maybe further amendments to Section 18, for example, making certain provisions around allowing branches to make to have deductions for, say, payments made to related entities, for example. So you make very valid points, but on the flip side, as an investor today, do you think this is disincentivizing any motivation to come into Kenya, for example?
Yeah, again, a very interesting question, and I think this has been heard in many other forums. The most immediate one is to ask ourselves why a business, is set in a country. What is the position for the tax consideration? There has been arguments that tax consideration ranks number 7. Others have contrary view. I am not sure. I think this is based on one's personal prejudice. But when you look at this issue, I would like to look at it in terms of reasons why companies prefer setting up foreign branches as opposed to incorporated, entities. First, there are those investors who would want to remain or to have a grip or to have control of the branch and the activities in the foreign, country. Now, this can only be done when you establish a branch, because basically, as I stated, a branch basically is the operation of the foreign company in a country. And therefore, it means the management is basically one. So you can't really see a branch independent of the head office or independent of the entity which is incorporated in the foreign country. So basically, the management will be one, or the directives or the instructions will be coming from head office, and therefore the whole control will remain with the head office. And for those investors who want to have that, then the branch becomes the most viable vehicle of investment. Then obviously, if it's an American company, for instance, the branch would be guided mainly by the rules of the US, where the head office is, they're more conversant with those rules, and therefore it becomes easier by the head office itself to manage the branch, subjecting it to the same standard, because the rules of the host country plays a much lower, role other than the issue of compliance. For instance, when it comes to organization, you just make a tax computation that conforms to the Income Tax Act, but everything else can be to the American standard. Then obviously it is cheaper to open a branch. You don't have to go through the whole process of incorporation. What you need to do is to make an application, you obtain certificate of compliance, and there you are, you start the business. And incidentally, branches are recognized all over the world. It's a very, very old concept from 1843 all the way to date. We have seen many countries coming together to determine how branches are going to be taxed through the development of the double tax agreements. And therefore, this concept is widely accepted, worldwide. And therefore, to determine whether entities will be incentivized to come set up in Kenya or not, then we have to take all these matters into consideration, including now the changes in the tax law, and depending on how they view it, then it may have some impact or not.
Yeah.
Back to you, Lydia.
Thank you, Patrick. And I think it's really helpful that you just highlighted other benefits of a branch form of business other than tax. So what I hear you explaining is it's not, the taxation rates are not the only motivation to set up a certain type of business, but there are all those other things, including control, including ease of setting up, ease of winding up as well, if you need to go back home. And all those should be taken into consideration together and not independently. I think I'll just pause there with you, Patrick, and I'll come back to you in a short while and move on to you, Kenneth. And picking up from where Patrick has left, in terms of there's still no specific withholding tax rates for the repatriation of profits for the branches, and we don't know how that will look like. However, connected to that, there's a proposed restriction on taxpayers from deducting withholding tax paid on payments to non-residents where, say, an adjustment has been made. What are your thoughts, Kenneth, around disallowing these withholding tax credits that have already been paid against a transfer pricing adjustment? And how do you think this aligns to the principle of equity in taxation laws, Maxine? Is there a risk of double taxation, for example? And how can taxpayers dealing with those based in the US or anywhere else in the world avoid this risk of double taxation? This proposal, and just before you come on, the way I understand it is that, say, for example, there's a subsidiary here, and there's a holdco seated in the UK, for example, and I operate as a subsidiary in the name of that holdco. I use their intellectual property rights here, and because of that, I obviously compensate them by way of royalty. And as I pay that royalty income to my parent entity, I withhold tax and remit to the Revenue Authority, which they obviously accept. And then I go through a transfer pricing audit. And of course, they test for many things, including the arm's length nature of that transaction. And they come to the conclusion that I ought not to have compensated the holdco, and to them that's, say, a disallowable deduction, so they scrap it off. My understanding of this proposal is that they will not return back the 10% or 15% withholding tax that they've already accepted, and they will, after disallowing that deduction, they will go ahead and still apply 30% full tax on that amount. What is your understanding of that proposal, and what's the implication to us?
Thank you, Lydia. You've described the proposal in pretty good detail. That's exactly what they intend to achieve. That in the event of an audit, and Patrick in his previous life, was well aware of how this process used to work. They'll come in, undertake an audit, disallow a portion of those expenses, which then results in an increase in your corporation tax liability. So in this case, you then have a higher income tax liability, but they want to then put aside the withholding tax that you had then suffered when you paid the royalties or management fees and so on. And also bearing in mind that in most cases, you will find non-residents sort of pushing the burden of withholding tax to the local entity. So you have gross up provisions, which then mean that this withholding tax was an actual cost that was incurred in Kenya because the parent entity probably received the payment net of taxes. So this by any standards is inequitable, is not fair at all, because they're seeking to then benefit twice. On one hand, they enjoy the withholding tax and also assess you from a corporation tax perspective. And the challenge with with transfer pricing, of course, there's an increased focus by the Revenue Authority on transfer pricing. Lots of disputes arising, lots of audits are ongoing. The challenge with that is these audits happen, probably 3-4 years after these payments have been made. What that means, therefore, is they've had this income for several years, and there was no certainty at the beginning as to whether these transfer pricing arrangements will be challenged in the future. So what, of course, we all need to push back against this provision. But also what will be helpful is for Kenya to introduce advanced pricing arrangements where taxpayers can sit with the Revenue Authority in advance prior to implementing their TP arrangements to then agree on their pricing arrangements. What that does is that it then provides certainty to businesses and also ensures that the risks that there'll be a challenge in the future and these adjustments will arise and so on is then reduced significantly. But in the absence of these advanced pricing arrangements, and they're pretty common all over the world, in the absence of these arrangements, then we then have the risk that we'll then suffer double taxation in essence.
Yes, Ken. And as you were speaking about equitability and all that, it just came to me that this is not even a potential risk of double taxation. If you think about it, it may even be triple taxation. Because remember, when the royalty or management fee income lands to the parent entity, the domestic revenue authority in that country also taxes that income. So if it's subsequently disallowed, remember that revenue authority, if it's IRS or HMRC in the UK, they will not return that that tax that they had already collected on that income. So disallowing it 2 or 3 years down the line is a whole chain of triple taxation. So you may end up with one transaction, one income tax up to 70% in some cases. And this is just something to keep on the back burner. And I like the potential mitigation measure you've put forward on just having preliminary discussions where businesses have such arrangements or have transfer pricing arrangements within the group. It's good to engage the Revenue Authority. And in my experience, in the last 1 or 2 years, the Revenue Authority are now moving to a more customer based or customer engaged kind of way of doing things, and they even assign relationship managers. So what, Kenneth, I hear you suggesting is ongoing conversation so that, again, you're not caught flat-footed at the point of audit, and these documents or arrangements are reviewed by the Revenue Authority pre-transaction. Again, there's also, where there are DTAs, there's also the forum for mutual agreement procedures between the relevant revenue authorities. As to how much this works, I only know of one done by the Revenue Authority in the last 5 years, which was not concluded anyway. I don't know if, Patrick, you may comment on that at some point. I don't know how that works, because I've seen revenue authorities drag their feet, especially where it may result in them returning some money. They really drag their feet under map and end up frustrating justice because of time. Again, still on non-residents and the legal framework, Kenneth, the other question that has been on the street since last week, Thursday, when this bill came out, is that there's a proposal to introduce a legal framework for the Kenya Revenue Authority here to enforce assessment and collect taxes under the Multilateral Convention on Mutual Administrative Assistance. And the proposal around this is that the KRA would now have extraterritorial tax collection powers, and the reverse is also true. In your view, and based on your experience, how this play out against, again, the confidentiality obligations under the same treaty? Do you think this domestic law would take precedence over that treaty arrangement? And how would this potentially affect American companies or foreign companies doing business in Kenya?
Maybe before I take that, I see Patrick's hand is up. I think he has a comment on the earlier question.
Yeah, go ahead, Patrick.
Yeah, thanks, Lydia and Ken. And I think Ken has made very important observations. I just wanted to add some historical perspective of Ken's question and how we get where we are now. Because for the longest, the question has been there is withholding tax, maybe on management and professional fee. Now, this is a payment that is made to a foreign entity, a foreign service provider. And therefore, the question has been, whose tax is this? So the argument has been, this is the tax of the foreign company. So when KRA comes and conducts an audit and reduces the payout, maybe from 100 million to 50 million, now it means that the other 50 million ought not to have been paid to the foreign company. But remember, the whole of 100 million has suffered withholding tax. So KRA has resisted for the longest, to refund, the balance. But some of the officers, depending on which officer you deal with, some of them were granting a credit, others were not granting credit. Obviously, when you look at it, and I worked for KRA for 26 years, and my position, I'm sure Alice knows, was that taxpayers should actually get a credit, but the foreign entity should get a credit because that is their tax. The problem was mechanism. How would they apply to get this credit back? That became a big issue. So, and therefore, all what Ken has said then stands. Maybe the only dimension that I wanted to bring here is, remember, when you reduce the payout from 50 to, from 100 million maybe to 50 million, the balance under Section 7 of the Income Tax Act also serves as secondary adjustment. There's a withholding tax of 15% because that amount is deemed to have been paid to the foreign company, for the foreign maybe related party, as dividends. It's a deemed dividend provision. And therefore, that is another tax on the same income. So we have multiple taxation on this particular issue. And I think this is an area that really Treasury and the KRA must relook. Even if they are so desirous of taxing everyone, at least they should tax once, and or just twice, but not 3, 4, 5 times. Thank you.
Yeah, Patrick, it looks like it's even more than the triple taxation I was speaking to. Yeah, thank you so much for that comment. And I think I'll give it back, Kenneth, to also give a rejoinder if you have additional comments on that, and then pick up on the issue of extraterritorial enforcement.
Thank you, Lydia. I fully agree with Patrick. And perhaps I think the APA regime was probably proposed when he was at KRA, but we haven't seen it seeing the light of day. But we do hope that going forward, as we enhance our tax legislation, then hopefully we'll have that regime being entrenched in our laws. Lydia, you raised a good point on the treaty and on the changes that we've seen being introduced in domestic tax legislation. And broadly, what they're doing is to try and domesticate provisions which are in this treaty, which came into force towards the end of 2020, which broadly allows the Kenya Revenue Authority to seek information and support from foreign revenue authorities in relation to tax obligations of Kenyan individuals and businesses. But at the same time, Kenya also has an obligation to provide the same support and information as well to foreign revenue authorities. And for this to then fully be operationalized, then we need these provisions then domesticated in our tax legislation, which is broadly what they then proceeded to do. Of course, there are a couple of concerns in terms of how this is supposed to work, because broadly, in the case of, say, American businesses, I think the US signed this treaty many years ago, and we'd expect that, in the event that there are Kenyan businesses, say subsidiaries or permanent establishment of US entities, which then have tax obligations in the US, then the IRS will then reach out to the Kenya Revenue Authority pursuant to the provisions of this treaty and seek the Kenya Revenue Authority support in collecting tax or obtaining information, which can then enable the IRS to determine what the tax liability of a particular business then is. Of course, with information sharing, and we've seen KRA rely on this treaty quite significantly to request for information, with Mauritius, with the UAE, and with other countries which are party to the treaty. But when it comes to enforcement and tax collection, then there are a couple of risks there that need to be thought through. And this is situations where foreign revenue authorities reach out to the Kenya Revenue Authority prior to the procedures in their own domestic legislation being exhausted. So in the same way that in Kenya, before KRA can undertake enforcement action, you then need to have gone through the appeal process to the High Court and so on. In the same way, in other countries, of course, it's difficult to tell what the procedures are, but there's a risk of a foreign revenue authority being overzealous and jumping the gun and going ahead to ask the revenue authority in Kenya to support them in seeking collection of taxes, even though the taxpayer in their home country is yet to fully conclude the whole dispute resolution mechanism. The good thing is, based on these proposed provisions, there is an opportunity to then seek redress through the Kenyan courts, the Kenyan tribunal, and so on. But also in terms of how this is fully operationalized and how the Kenya Revenue Authority practically handles these requests, we expect to see a bit more detail in terms of ensuring that procedures are respected and there is consistency in terms of how these requests are received and processed, to then avoid a situation where there's premature introduction and reliance of the treaty. It's the first time we're seeing these provisions, and of course, we'll wait and see how this works. But of course, ultimately, when it comes to issues around privacy, for example, the Constitution enshrines that right for all taxpayers and businesses and individuals alike in Kenya. And of course, even the treaty itself has some very high thresholds around ensuring there's confidentiality in how data is handled and how information is then transferred. So unless we then see these provisions being tightened in terms of how they're being introduced in the Tax Procedures Act, we see a potential of abuse by foreign revenue authorities, and ultimately challenges being raised by taxpayers in Kenya who are affected, seeking redress really through the Kenyan courts.
Yeah. Thank you so much, Kenneth, for that. And I like the way you've kind of walked us through the various levels of dispute resolutions before you invoke international law. As he aptly put it, and there have been so many commentaries around this, this proposal needs to be reinforced to provide for you need to exhaust domestic avenues before proceeding to collect taxes or to assess somebody under the treaty. I'd like to switch gears a bit, and thank you so much, Kenneth, for those comments. I'll circle back to you. I'll now move on to Alice and move on from the perspective of the value-added tax. Yeah. So Alice, the bill proposes to reclassify transfer of businesses as a going concern from the current standard rating, which is at 16%, to exempt. In your view, do you think this will have a positive impact on the current economic climate, especially for businesses in distress, thinking in the context of the climate that Ken spoke about when we were looking at the macroeconomic situation? Do you think this will encourage potential investors, because then it would be 16% less payment if you're acquiring a business as a going concern? Or do you think this proposed change is moot in the context of how VAT works, input VAT, claiming that, and such nuances that may not be obvious at the face of this change?
Yeah, no, thanks, Lydia, for the question. So maybe just to give a background as to the proposed amendment, the Tax Laws Amendment Act of 2020 actually changed the VAT status on transfer of a business as a going concern from exempt to VATable, and that was in April 2020. Now the Finance Bill 2023 is proposing that we go back to the exempt status. Yeah, Patrick had touched on these, and I think Ken as well had touched on these, and this is with regard to the instability and uncertainty of the tax policy. Yeah, so we are seeing just in a couple of years, we're reverting back to where we originally were, which was exempt, which makes it very difficult for businesses to plan. And this VAT on transfer of businesses is a key area for us in Kenya, given that we are sort of an investment hub for the region. We do position ourselves as an investment hub for the region. We have entrepreneurs who are constantly building up the businesses, and at some point they want to exit. So there's no stability with regard to, the tax deal space with regard to what is the VAT status when you transfer a business. I think that's a big concern. And, we keep talking about the national tax policy, but, this is really a fundamental issue to try and stabilize and give certainty to the tax framework. Yeah. Now going to your question, the status now moves from VATable to exempt. So previously it meant that if you were transferring a business as a going concern, you'd have had to load 16% VAT. The transfer of the business would have had to load 16% VAT. And that makes it a little bit more expensive for the business, given that what they're trying to do is really mobilize cash flow and probably even get an exit strategy for themselves. The ideal situation would be where the transfer of the business as a going concern is zero rated, because then it means that you'd be able to recover some of the input VAT that has been spent on the transaction. So that would be the ideal situation. I, however, do think that an exempt status is a good halfway house where, you're not able to recover the input VAT, but at least you do not increase the transaction cost by a further 16%.
Yeah, that's right. And there's so much focus now on VAT, and I think what the Revenue Authority and the government is trying to do now is promote the adoption of e-teams very aggressively, because through e-teams, they are not only going to ensure compliance with VAT, but even that they are going to use that to institute audits on corp tax, where whatever it is you've reported on e-teams do not match up to your revenues. So part of the proposals around e-teams, Alice, is by introducing a requirement that taxpayers only now conduct business with suppliers who are VAT compliant in terms of having onboarded and working through e-teams. In your view, is there a risk that this is likely to carve out or disenfranchise startups or small enterprises who may not, as of this point, qualify for VAT registration and therefore do not have e-teams? Who will they be supplying to? Because then the bigger businesses are only now working with e-teams compliant suppliers. What does this mean?
Thanks, Lydia, for the question. So my understanding of the provision is that there's now a stricter requirement for a business to deduct input VAT. Before you deduct the input VAT, you must have a valid tax invoice. And on top of that, you must make sure that the person, your supplier, the person who has charged you the VAT, has accounted for the VAT. So traditionally it was just you have a valid tax invoice, but now on top of that, has the supplier accounted for VAT? Yeah. So I don't think it's so much saying you can't trade with these guys, but it's increasing the cost of doing business because that VAT will not be recoverable to the extent that those two conditions have not been met. Yeah. In my perspective, I think this is a significant departure from what we are trying to do with the tax invoice management system, the electronic tax invoice management system that was rolled out last year, which was to allow KRA to get data around VAT and to some extent income tax on a real-time or near real-time basis. Yeah, so then KRA is able to make those reconciliations themselves based on the electronic platform that they have prepared. So I think it's quite onerous now to require the individual taxpayer to make sure that the other person has accounted for VAT, and KRA already has a system for making sure that the VAT is accounted for on a real-time or near real-time basis. I also think the proposal for that you can only deduct an expense for which VAT has been accounted for from an income tax perspective, I think it's quite punitive, right? First of all, the framework for VAT is anchored under the VAT Act. The framework for deductibility of expenses is anchored under the Income Tax Act. The criteria for a deduction of an expense under the Income Tax Act is whether you have incurred that expense wholly and exclusively to earn taxable income, right? And that is, that is the philosophy or the whole idea behind the Income Tax Act. So then again, to require that your taxpayer can only deduct an expense for which VAT has been accounted for is really punitive from my perspective. There are some exemptions proposed. So the provision in the finance bill is saying that the exemption will apply if you're not required to account for VAT in accordance with the Tax Procedures Act. So I would hope that the interpretation by the Revenue Authority towards that provision is that for expenses that you ordinarily do not account for VAT, such as accruals, provisions, or even for people who supply to your business, smaller businesses, but have not met the VAT threshold. So I would hope that that will be the interpretation with regard to the exemptions provided in the Tax Procedures Act. Thanks.
Yeah, Alice, and thank you so much for those comments and just for giving that perspective in terms of how this works out and the kind of overlap that the Revenue Authority is trying to create between the VAT Act and the Income Tax Act. And I am concerned about your last comments around accounting, leaving this to interpretation in terms of we can only hope that the KRA's interpretation of the proposed exemption is that this would not apply to expenses or costs that ordinarily you would not account for VAT on. Because then if you leave it to interpretation, we all know that somebody at the KRA would be more inclined to adopt an interpretation that would potentially bring in more revenue as opposed to the other way. So leaving it into interpretation just does not count it. And my view would be for it to be provided for expressly in law where there is any exemption and this be listed, instead of leaving it to taxpayers and the Revenue Authority. What we are likely to see if it's left as is then an avalanche of more assessments and more tax disputes at the tribunal and even the higher courts. But I think you make very valid points in terms of the practicability of this, and it's just, it will be, if passed into law, administratively laborious to require you or to require me to ensure that somebody supplying me by anything is VAT compliant when I don't have sight of their processes and all that. Still on VAT, Alice, there's a proposal to now move exportation of taxable services to VAT exempt. Do you think this will reduce the cost of doing business in Kenya, especially for service providers or professional service firms like ourselves, me and you? From a VAT perspective, is this a win, or are there nuances that are not obvious to us from moving it at standard rated and to exempt? Because the way I see it as an entrepreneur and as sitting on this side as a service provider is, as it is standard rated currently, I get to recover the 16% by charging my client and they pay for it. So my profit margin is not touched under the current standard rating arrangement. However, with this proposal to move it to exempt, then I would be unable to claim my input VAT, and I cannot pass on that cost to my client. So is this really good news in your view? And how does this compare to international best practice?
Thanks, Lydia, for the question. This has been a very topical issue with regard to the VAT status on exported services. The reason why this tends to be, controversial is because for an exported service, unlike a good which you physically move out of the country and say the good has left the country and therefore the service is exported, the good is exported, that does not necessarily happen for a service, yeah? And the debate over the last couple of years has been, how do you determine that this is an exported service because the consumption of the service is taking place in Kenya? Yeah, it sounds outside Kenya. I apologize. It sounds easy, but if you actually, try figure out what are the criteria for determining where the consumption of the service is, it does tend to be quite complicated. Yeah. So I think again, to start off, I would just like also to start by saying that these amendments is an indicative of the instability of our tax policy. When we started off a few years back, exported services were zero rated. And then there was the amendment where they actually became VATable. And then last year, Finance Act 2022, they became VATable unless their business process outsourcing, a BPO. And there was no definition as to what a BPO is. And you can imagine the room for litigation and interpretation that was leaving. So the whole economic principle generally from a best practice perspective around exported services is that VAT should be charged in the jurisdiction of destination, yeah? So where the consumer is based. If you have a jurisdiction such as ours in Kenya, where you're attempting to charge VAT in the country where the service is originating from and not where it's being consumed, it contravenes the established international best practice around VAT and consumption of service. And that really has been the debate. And what happens is that if you charge a foreign entity VAT, so for example, me in Kenya, Alice, I'm providing a service to a Ugandan business and I charge them VAT, it makes the cost of the service I'm providing more expensive. But most importantly, they will not be able to recover foreign VAT in their jurisdiction. And that is where the principle is that the VAT should be charged in the country where the service lands or the country of the destination. I think the ideal scenario would have been for, to follow the international best practice, which is for VAT to be zero rated on an exported service. But now where we are landing at is that VAT is exempt. That means that you'll not be able to recover the input VAT associated with performance of the service. But I do still think it's better than where we are coming from, which is that VAT is accounted for at 16% on the exported service.
Yeah. Thank you, Alice. Thank you, Alice, for that very comprehensive explanation of the history. And it keeps looking to me like we are going back. It's straight from when Patrick started on with the branch. How is that treated? It looks like we are going round in circles. And even now, this VAT, where we were from and where we are going. Still on the indirect taxes, I'll now move on to excise duty. The bill proposes, and I know this doesn't affect all businesses, these would only affect certain service providers not service providers, suppliers of certain goods, and you possibly speak to that as you answer this. The bill proposes to expand the excise duty tax net to any costs related to connected digital lending. And the background of this is in the last, say, 5 years, there's been a lot of mobile phone lending and digital lending penetration into the Kenyan market. And I know there's been several attempts by the central bank and other regulators to just regulate that and bring them in the ambit of financial services and possibly have them pay their fair share of taxes. So possibly this is what has also motivated this particular change. Now the question is, do you think this would further increase the cost of borrowing through the digital lending platforms, considering where we are at and how popular it is for obvious reasons? People, the cash flow, there's no money in people's pockets and they need to find a way to get by. So they have resorted to this digital lending, which is now being proposed to come into the ambit of excise duty. Do you think this is going to further increase the cost of borrowing for the average man or low income earners?
Yeah, thanks, Lydia, for the question. I think first of all, it's important for us to try and appreciate the role of these digital lenders. I think they do get quite a bit of negative press. Probably their behavior over the last few years could have been better. But I think for me, what the digital lenders do, they're micro lenders. Actually, that's what they call their loans. They lend very small sums of money, 1,000 shillings, 5,000 shillings, 10,000 shillings, and with very low repayment period. There has been very short repayment period. There has been a debate as to whether what they are doing is what really the banks, is the same role that the banks do. But my view is that they serve the micro segment of the economy, even smaller than the small and medium enterprise, because the loan they are giving is 1,000 shilling, 5,000 shilling, 10,000 shillings, and with a very short repayment period. So the question is, would this person who needs a 10,000 loan to repay in a week time be able to actually approach a bank and get a 10,000 shilling loan? Yeah, you know, there would be some concern or some doubt around that. So I think they are playing a good role to facilitate credit intermediation for a portion of the economy that would probably not be able to access credit from the more formalized banking sector. So given that the role that the digital lenders is playing is the same as the bank, yeah, which is credit intermediation, albeit serving the lower end of the market, is it really fair for us to introduce excise duty on all the service fees they make, including the service fee on the loan, considering for the formalized banking system, excise duty does not apply on interest income. It's a specific exemption on that. So I think fundamentally from an economics perspective, there's an issue as to whether you're discriminating against the digital lenders because they're lending on the digital platform, while they're still playing the role that the formalized banking system is still playing. Yeah? Of course, this will make the product more expensive, yeah, because now there's an additional excise duty to be charged on the service income that they are charging to their customers. So that means that their loans will be more expensive. As to whether it will reduce the volume and the value of transaction, I think that's quite debatable, because at the end of it, at the end of the day, the small traders still need to access credit quickly and repay it quickly. It could sort of reduce the liquidity of the market, but I don't expect that it will be that significant, because at the end of the day, they still need the liquidity. And remember, I said I don't think they can really be able to access credit from the formal banking sector.
That's right. Yeah. Thank you for that insight. And thank you so much, Alice, for those comments on the VAT and excise duty. I will now move on to our other panelist, Kivindio. And Kivindio, I'm now switching gears to the procedural areas of tax, specifically the Tax Procedures Act. And the main change around that, and I know this was alluded to when we were introducing ourselves, is the requirement, the proposal to now pay to play. There's a proposal to introduce a 20% deposit or a security of an equivalent amount if taxpayers are instituting appeals from the tribunal to the High Court. I know this is not a new proposal again, and maybe you'll speak to the background of it shortly, and it just points to what the general theme has been with this finance bill. Are we going back? What's happening? If it didn't work then, will it work now? And it looks like Treasury are not giving up on this. Do you think the proposed threshold reduction from the previous 50 and the other amounts to 20 will make it pass this time round? And what's the place of this in the context of the right to access to justice? Will this make justice unnecessarily expensive and impede access to justice? Think of this in the context of the billions of shillings assessment that we are now seeing from the Revenue Authority. If you take 20% of that, then really, what is that going to do to your business from a justice perspective? Kivindio?
Yeah, thanks, Lydia. I think you captured it very well. It's as if we are going back, because this is not the first rodeo the Kenyan taxpayer are having in respect to requirement of taxpayers to deposit with the commissioner a specific percentage of, let's say, the tax in dispute or security equivalent to that specific percentage of disputed tax before either they file the appeal before the High Court or before the High Court, or moving from the tribunal to the High Court, or instituting initially to the tribunal itself. I think historically, and I think Mr. Chege can concur with this, when you look at the repealed VAT Act, that was Cap 479, it had a similar provision. I think it was a section 33(1), where it provided that one needed to deposit a full amount of the disputed amount before you can proceed and appeal to the tribunal. And then this provision, I think it was left out when the VAT Act 2013 was coming on board. We then saw a similar proposal in 2015, but the most identical one has to be the one for Finance Bill 2022, where they have, when you compare with the one before us right now, they've only tweaked a few things. That is changing the rate from 50% to 20%, as well as leaving out. Last year, they had given a proposal for creation of a special account with the Central Bank of Kenya. But this time around, they have left that particular provision and indicated only a credit will be given. And I think the change of the rate, let's say from 20% to from 50% to 20%, I think doesn't cure the same ills which were provided last year, where the provision was proposed under the Finance Bill of 2022, and they didn't pass the muster when it was presented before Parliament. I think the same thing still holds, and which will affect the taxpayer. One is the question of limiting the taxpayer's right to a fair trial. We need to understand that the right to appeal is encompassed within the right to a fair trial, which, when you look at our constitution under Article 25, is one of the non-derogable rights, which cannot be limited. And I think the biggest effect will be mostly for the taxpayer, because it will affect the cash flow of any particular business which wishes to, let's say, proceed to appeal a matter from the tax appeals tribunal all the way to the High Court. And this will affect the small trader, which I think Madam Alice was also alluding to the biggest one who is trying to enjoy, let's say, the benefits of a DTA, a double taxation agreement. Let's say, for instance, you've gone through the entire transfer pricing process, you've done your comparability analysis, you've found at the end of the day, there are some specific taxes which are being questioned. And then within the treaty itself, there's invocation of the mutual agreement procedure, where there's you try the two revenues, whether it's IRS and KRA, they try and solve that particular matter. But still, that particular taxpayer has an issue with it. As proposed earlier by Kenneth, it would be better, first of all, to exhaust the local remedies which you have in here. And if that particular individual is to present a matter before TAT, and TAT decides in favor of the authority, then they would wish also to exercise the High Court, the Court of Appeal, the Supreme Court options, if they wish to. Therefore, giving them that requirement of giving a deposit of 20% at the end of the day, I think for us, it would be very giving pressure mostly to businesses and straining their cash flow requirement.
Yeah.
I think thirdly, the other thing which will be highly affected is that the tax authority may now be emboldened, we're very encouraged to give out exaggerated assessments, wedging that if they go to the tribunal and at the end of the day, they get a favorable decision, as a taxpayer, you're supposed to leave out that 20%. Therefore, it will be leaving a lot of taxpayer in a limbo, whether they need to proceed and appeal most of these matters. And this also affects the issue of the ADR procedures which are proposed. because when we look at the ADR process, both parties need to come on table on a good footing, on a mutual footing, on an equal basis. But when you walk to a TAT, or when you walk to an ADR procedure, where one particular party has the option to exercise their litigation so that they cede, they get the favorable decision so that you can see the 20%, it becomes a pressure point for you to negotiate when we head to ADR. So I think the proposal itself, although is given to try as much as possible, give the government much revenue which it needs, it is ill-timed and should not be allowed, and should also, I think, suffer the same fate of the same proposal of 50%, which was introduced by the finance bill of last year. This, for me, looks like those very options of throw, see what sticks, and then if it is allowed, then that's good for you. If it doesn't allow, then you can try it next year and change the
Yeah, thank you, Kivindio, for those very insightful comments. As you were speaking to the tweaks done within this finance bill, you mentioned they've changed the requirement to deposit with central bank, and now it will be with the Revenue Authority. Are you at all concerned around KRA's ability to refund within 30 days upon successful appeal? Is there any merit on the general public being skeptic around KRA's track record of refunding and the government's, I think this is in the public knowledge, cash flow issues? Do you think upon winning, there will be a sticky point around refund?
Generally, I think you pointed out very well that the issue of tax refunds in Kenya has been a sore spot for most taxpayers in the country. And I think currently under Section 47 of the Tax Procedures Act, there is the requirement that one can apply, let's say, for refund of overpaid taxes for 5 years. And then that particular refund can be processed within, let's say, 6 to 12 months. But realistically speaking, as I think there was a report which came out on Wednesday, that the authority has an outstanding backstock of refunds worth around 31.2 billion. And then additionally, you remember in February, the authority itself issued out a notice indicating that refunds in the country, any forms of refunds, will be withheld until further notice if they give directions in regards to how to deal with the issue of refunds. Therefore, by comparison, when you look at the proposal to introduce the refunds, even if you win at the High Court, refunds within 30 days, that skepticism still holds. And this is mainly because within that particular provision, it's not very clear. After you proceed to the High Court and the authority wishes to proceed to the Court of Appeal, will you be allowed to be refunded at that particular stage, or do we wait until you exhaust all the other revenues or other means of dispute resolution so that you can get your refund back? Again, the issue of the way you've pointed out, the issue of the taxpayer and the cash flow still holds. There is no specific provision within that requirement of refund that there will be an issue of interest. Will the taxpayer's money accrue interest? And we are very aware, all of us, that any money which is put somewhere on hold, then times becomes a factor in which will affect it. Additionally, we can also look at the provision itself. It speaks of two unidentifiable times. One, it speaks of a question of security. It doesn't go ahead and define what type of security will you be providing. Is it in a form of property? Is it a digital assets? It doesn't go ahead and clarify. Secondly, there's also the question of credit. I think this one is being borrowed from the previous provision, which I highlighted earlier, the VAT Act, which was repealed. There was a term of credit. It will be credited to the taxpayer's account. Therefore, it begs the question of, if it is credited, does it mean it will be refunded? Should it be credited only to future taxes, to current taxes which are pending, or should it be a refund which will ought to be given? I think at the end of the day, this proposal should not be allowed, because we need to appreciate that procedure is the handmaiden of justice, not its mistress, and that's the principle which. Therefore, the rules and procedures should not be used to curtail a taxpayer's access to justice and have stifle genuine claims which are being brought before the various tribunals.
Yeah, so aptly put, Kivindio. And you mentioned ADR at some point, and Around that, there's a proposal to do away with the commissioner's discretion to waive penalty and interest for taxpayers or make any recommendation for waiver to the CS on account of hardship, equity, or even where they agree under ADR. Do you think this proposal renders the ADR process moot? Because that was the kind of, so to speak, that was the enticement for taxpayers even to sit at ADR table. And without the capacity to have penalties and interest waived or any level ground to start and to start from at the table, will this render ADR moot? Whether or not, I'm aware there's another proposal to also extend these ADR timelines. Is this going to defeat ADR? And where does this leave the current amnesty around the voluntary tax disclosure program? What would happen post June 2024, which is the end of transition period for this proposal? Do you think the proposal to scrap off this discretion is just going to make KRA more aggressive and obviously leave the taxpayer with no room to negotiate at all?
Lydia, in my opinion, I think presently we have 3 proposed ways to deal with such particular issue. And I think the first one, the ADR process itself, it's already captured within the law. There is supported by Article 159, and then you have the Tax Appeals Tribunal, and then you also have the rules which support the ADR process. And I think there was a decision by the Tax Tribunal which held that any particular agreement which is signed between the tax authority and the taxpayer, it is binding and it ought to be implemented as per that particular agreement. So you cannot deviate or start including penalties or liabilities or interest to a certified amount which has been accorded within an ADR process. Now, we come back to the other two processes which have been proposed. There is deletion of Section 89, which gives the commissioner the discretion to waive penalties and interest for taxpayers. But at the same time, there's a proposal of introduction of Section 37E of the tax amnesty. Now, the question would be, how do we compare this new proposed Section 37E vis-a-vis the already operating voluntary tax disclosure program, which is captured under Section 37D? I think 2 key things stand out. The first one is the question of audience. Who is the target market for these 2 provisions? When you look at Section 37E, the target market, I think here, is for taxpayers who have the tax have become already due and payable. Hence, they need to pay that amount of tax, and it is known to the authority itself. When you look at the voluntary tax disclosure program, which was introduced by the Finance Bill of 2020, it targeted taxpayers who have tax liabilities and are unknown to the tax authority. And as such, I think the coexistence of the 2 forms of amnesty can continue because the target market is different. For the voluntary tax disclosure program, is for the unknown tax liabilities that the tax authority doesn't know. But for the tax amnesty under the proposed Section 37E, it will take care in regards to known tax amounts. The other thing we need to look at is the timeline. As correctly pointed out, the one for voluntary tax disclosure is coming to an end in January 2024 because it was introduced for only 3 years and it had a cascading form of dealing with waiver. The first year, 100%, the second year, 50%, and then the last year, which I think is the 2023 to 2024 year, is the 25%. When you compare again now to the proposed Section 37E, it also points out that the Commission can issue waivers if the principal has already been paid before 31st of December. And then from there, you can have an opportunity to negotiate with the Commissioner and have a signed agreement whereby you need to pay before the 30th of June 2024. So both procedures, in my opinion, can exist concurrently, given that the audience targeted is different and the timelines which are being focused on are different. And additionally, the ADR procedure, which is governed by the TAT and the procedures which are attached to the ADR process before the tribunal, those ones can also run separately. So this can be able to be a balanced area where interest and penalties can be dealt with.
Thank you. Thank you, Kivindio, for giving that clarification around what that change means. And I know Kivindio has spoken a lot about this should not pass, this should be pushed back. And I'd just like to share that the National the National Assembly Finance Committee has now invited the general public to issue their submissions or proposals for change or anything we would like considered, even as they look at this finance bill. And I know the American Chamber of Commerce sent out a request for proposals. I urge all of us to put all these comments that we are discussing in this meeting today, in this forum, into that call. And I know various stakeholders, including ourselves, ISPAC, will be submitting these proposals. And I know at some point we will even go in to make oral submissions. And these are some of the things that we are certainly going to push back on, based on feedback from taxpayers, based on our experience, and based on just goodwill on what is good for the Kenyan general public. I know the panel discussion time is well spent. I'll just throw back one or two questions. I see a number of questions coming in hot and heavy in the chat. Keep them coming. In the next, maybe I'll take the next 10 minutes to pick some of the questions, but I know some will also be responded to directly by the various panelists. They will respond directly on chat, and for those that they will not have responded on chat, I will read them out, then we can discuss. Before we do that, I'd like to come back to you, Kenneth, around the proposed digital assets tax. This is a new tax. What is it, and to whom is it intended to apply? You can take maybe 1 or 2 minutes to very briefly speak to that, Kenneth.
Thank you, Lydia. Yeah, we've seen for the first time this digital asset tax being introduced. Globally, countries are grappling with how to tax cryptocurrencies, and this appears to be one of the transactions that government is trying to bring to the tax net at the rate of 3% of the transaction value. So every time there is a transaction, then there's an obligation on the platform owner to then deduct 3% and remit it to the government within 24 hours. So the other rules around withholding tax being remitted to government within 24 hours also apply to this new provision as well. There are a couple of technical challenges in terms of how this is supposed to operate, because it seems for the first time this tax is supposed to be paid by Kenyans, so it's based on residency, even though our tax regime operates on the basis of source where income is accrued in or derived from Kenya. So there are challenges that are likely to arise with these non-resident platform owners as to how they identify, for example, that this person transacting is a Kenyan, and then ensuring that they have deducted that tax and remitted to the government within 24 hours. In addition to many other tax compliance obligations that these platform owners may have in other parts of the world. But of course, being the first time we're seeing this new tax being introduced, we'd expect that there'll be additional drafting issues that will be corrected and streamlined in the coming days. But as it is currently structured based on the finance bill, we don't think it's possible for this regime to operate without further thought being given to how this is supposed to operate. But broadly, the intention is to catch people who trade in crypto, but also bearing in mind that we've seen a bit of downturn in that space in the last couple of months and years, and bearing in mind that they now want to tax the gross consideration value, it may be a bit unfair on platform owners themselves, but also on individuals who are also trading these cryptocurrencies and non-fungible tokens.
Thank you for that. And Alice, I saw you had your hand up. Even as you come in to speak, there's a question here on VAT. For the service VAT jobs outside Kenya, would that be tax exempt?
All right. I think I just wanted to comment on the question that was posed to Kenneth around the digital asset tax. I really strongly feel that it goes against the spirit or the philosophy of income tax. Yeah, income tax is tax on gains or profits. The proposed digital asset tax is a 3% tax on the value of the crypto or the value of the digital asset. And you can actually end up in a scenario where the transferor is paying tax, but they have made a loss because the tax is being computed on the value of the asset and not on the profit. So it really is, I think, grossly against the spirit of income tax. And I think it's a tendency we've seen from a policy perspective to introduce turnover-based taxes in the Income Tax Act, such as turnover tax, digital services tax, which is another kind of a turnover tax, and now we have the digital asset tax. And I think, it's a policy consideration that needs to be had. I also wanted to just briefly comment on the 20% pay to play that Kivindio took us through very well. I just wanted to put in my perspective is that it will incentivize bad behavior. I think we need to be alive to that, because then the assessing officer or the KRA knows that if they put in a frivolous assessment of a billion shillings, before the taxpayer goes to the High Court, they'll be required to deposit 20%, and that 20% is accessible to government. So I don't think we should be legislating provisions that have capability to incentivize bad behavior. And then we know how long litigation takes, tax litigation specifically, it takes years. For example, we have a case that will be had at the Supreme Court that one of the players in the banking sector has been taken through the tax system for the last many years. You can imagine if they had deposited 20% of the value of the tax in dispute and the impact it has in terms of depriving the business working capital. Okay. Now going to the question, I think the question is around VAT on services. So VAT, the way the VAT system is designed in Kenya, it's based on the service that is being provided from Kenya. And the question around export of services has been, who is the consumer of the service? Is the consumer of the service a Kenyan entity? Or is the consumer of the service a non-resident? If it's a non-resident, traditionally, it has been seen to be an export of service. Although last year, there was a change in that policy such that it was VATable. But if you can prove that it's a business process outsourcing kind of service, then it was exempt. Now the direction is that whatever service you're providing for a non-resident, even if the activity is taking place here, that service is exempted. So I think it's an improvement for me, because first of all, it removes the debate as to whether it's a BPO, a business process outsourcing, and you do not add 16% VAT on the cost of the service. However, the best scenario would be for it to be zero rated so that you can be able to recover your input, but we've made progress, that's where we are. So maybe eventually we'll be able to zero rate the exported services. Thank you.
Thank you for that. There's a question for you, Ken. How do you see tech as a growth engine for Kenya, and how should the government provide tax incentives to grow this space? Ken?
Many thanks for that question, Lydia and Anthony. Indeed, technology is a major growth engine for the economy. If anything, I call it the fifth factor of production, given that we are moving into a digital economy. And technology creates certain new opportunities. Number one, I think it allows for digitization of the factors of production. When you talk about, for example, the lands, the digitization of lands, it's meant to make transactions easier and faster, to be able to unlock capital. We've talked about digital money, the likes of M-Pesa. So it unlocks the things that we need to produce. And that's, I think, a wonderful thing. Number two, technology also helps in price discovery. Think of the Uber space, for example. Before the world of Uber, if you went into a taxi, the taxi driver would pretty much profile you and sort of just give you a very random quote of how much it would be. But now with technology, that whole price discovery, the whole information asymmetry is removed. So that's pretty significant. And I think lastly, it creates new careers. You think of content creators, social media strategies, these are new careers that are taking place, particularly with the youth. So I think from a government's perspective, if its intention is to create employment, growth the economy, they should really reconsider some of the taxes. They should really avoid milking that cow, if you like, and sort of help it prosper until it's in full maturity. So I think there should be great incentives on taxes that touch on digital money, for one, taxes on content creators. I saw these are 15% withholding on content creators, up from 5%. I think possibly that needs to be reflected on. But the whole philosophy should be keep it into a low tax environment to allow more and more people to prosper. I think sometimes there is that idea that if you tax people more, the government will raise more revenue. But in economics, there is that concept of the Laffer curve that says at some point, if you overtax people, you end up disincentivizing people to engage in that sector. So I think it's important we don't get to that tipping point where we disincentivize, particularly young content creators and young entrepreneurs. Thank you.
Yeah, thank you, Ken. There's a question here for you, Kenneth, then I'll circle back to you, Patrick, as well. To you, Kenneth, first, there was an expectation that the DST will be removed from the Income Tax Act in light of certain comments the president made during the AmCham summit. Has this been achieved?
Thanks, Lydia. Unfortunately, in terms of the promises which were made by the president a couple of weeks ago at the AmCham summit, I think only the DST removal has not seen the light of day. The rest on export of services and so on have all been implemented, but we are all waiting to see the withdrawal of the DST regime. That has not been reflected in any form or shape. And I think it's an area where certainly AmCham and its members will need to make submissions on, because the impact on non-resident tech companies is has been clearly felt. Closer home, looking at Uganda shelved its plans to introduce DST. They had it in their bill, but the understanding is that Parliament shut that down. And I believe, I think during the deliberations in Parliament, they probably made reference to Kenya also, seeking to withdraw their DST regime as well. So I think it's an issue which needs to be reconsidered. Hopefully, we will see the provisions coming in the Finance Act, either with some timelines of that withdrawal or a firm commitment by government that probably if there's consensus, the OECD, then we will see DST being withdrawn. Lydia, I think you're on mute.
Sorry about that. And thank you so much, Kenneth, for those insights around DST. Now, moving on to the next question, I'll take two more since our time is well spent and we're just trying to go through the chat. I know some are being responded to real time on chat. I'll take two more, then we can move on to closing remarks. So there's a question to you, Patrick. There's a proposal to change the withholding tax due date from the 20th day of the month following payment to 24 hours after payment. How would this look like for those accounting for transactions on accrual basis, and even from an administrative perspective? How does this look like? You can take a minute or two, please.
Thanks, Lydia. I think this is a little shift from the traditional, practice and law, where when you deduct tax, then that tax is due the following month on the 20th. And that really served the business very well because they are able to manage their cash flow. They're able even to, to take the payment through the approval, system and so on and so forth. Now we are talking about 24 hours. Really, that is so to say, something that is unimaginable. Because I think when KRA came up and Treasury came up with these proposals, they didn't have business in their contemplation at all. I think this was just serving the interest of the government to get cash flow, at the earliest. Now, if you imagine somebody who accrues a payment, accrue does not mean that you have the cash. You have just recognized that somebody has rendered services to you, you haven't paid, you accrue the cost because there's a cost. And based on the income tax definition of paid, you deem to have paid. And the following day, you'll be required to pay the withholding tax. And therefore, it means that this law will impact very negative on cash flow because many taxpayers operate at deficits and they have no ready cash anytime. And second, I've stated in terms of approvals, sometimes it takes quite a longer time, to have some of these transactions approved. And 24 hours is not enough. Not even to forget that there are some businesses with very, very many transactions that serve withholding tax. So unless they employ additional labor force, not basically driven by business, but driven by taxation, then it will be almost impossible to be compliant, to this law. So it is not a very good law. We think this is one of the issues that we shall be submitting against before the Parliamentary Budget Committee to go back to at least payment on the 20th. And if that cannot be achieved, then we establish a kind of a middle ground, maybe payment by 9. Like the way we do pay as one, but basically 24 hours. I haven't seen a country that has taken this direction, and I think we should, Robbie, to have this or changed. Thank you.
Thank you, Patrick. I spoke to some colleagues from the Revenue Authority, and they're saying that model has worked with the betting companies. Are we moving to an economy where the Revenue Authority will even now require our ERP systems to be integrated with theirs? Because I don't see how this will work within 24 hours if we don't integrate our systems. And otherwise, that's all we will do. We'll be just generating payment slips and paying tax, and with very little time to actually do the business. What are your thoughts around that argument that it has worked in other industries?
Yes, number one, we must acknowledge the fact that, for the betting industry, there's integration of the systems. And maybe what KRA is not telling us are the hues and cries that are happening between them and the betting companies. They are not as comfortable as KRA would want us to believe. Now, you imagine this becomes a principle of general application. We have even areas without electricity. We have very many businesses without, some of these gadgets. How are they going to, to operate? This is trying to register an impossibility, and I think this is moving in the wrong direction. So I don't think that's a valid argument by the KRA. They should look at each case on its own merit. We have very small businesses that cannot even afford some of these gadgets. So I think it's an area they have to look at.
Thank you, and thank you so much. I think this is just, we will end there with the questions at this point, but I know if you still have a question that will be responded to on chat, I know a couple have been taken care of by the various panelists. Mine is to thank everyone. This is all the time we had this morning, but it is only the beginning of the conversation. This affects us, and it's our duty, it's our duty as businessmen and women working in this market, as taxpayers, as Kenyans even, to participate in our civic duty by submitting those proposals and the comments we've had in this meeting to the National Assembly Committee. So as we wind up, I'd just like to also give the panelists another chance to say one final remark each. As we wind up, then I'll hand over the meeting back to you, Eva. I think I'll start with you, Kivindyo. what is your one parting shot that you want us to leave with this morning?
I think as Kenyans, we need to exercise that right to make sure that our opinions are heard, make sure that you submit your opinions back to Parliament before 20th of May, and ensure that the provisions which you feel they affect you are well brought out and the government can hear the people in respect to the provisions which have been proposed within the Finance Bill 2023. Otherwise, it was a good opportunity, and thank you for every panelist for contributing for this particular session. Thank you.
Thank you, Kivindio. I'll move on to you, Patrick. Closing remarks.
Yeah, I think for me, just remind the government that there's no single country that has ever taxed its own people to prosperity. The moment you introduce all these form of taxes, what we're doing to your own people is to reduce the saving component, which basically is called back in form of investment, job creation, and so on and so forth. And therefore, then these multiple taxes are harming the economy more than they are building the economy. So then, thanks everyone, and I hope we meet next time. Thank you.
Thank you. You, Alice?
Yeah, my parting shot is that this finance bill has far-reaching consequences for everybody. I'm particularly concerned about the reduction in disposable income and also the increased cost of living due to the increased taxes, especially the consumption taxes. That means every household will have lower disposable income, and that's a concern for me. My message to government and policymakers is that as we design the tax policy, it's very important for us to design a sustainable tax policy. A sustainable tax policy is that we're able to collect taxes today, but tomorrow the same taxpayers will be there and they'll be thriving and the economy will be growing. So we'll be able to collect even more taxes. So there are questions as to how sustainable the approach we're taking towards taxes is. Thank you. And thank you, AmCham, for the opportunity, and hoping we'll continue to engage.
Thank you. Thank you, Alice. Ken, closing remarks?
Many thanks, Lydia. Mine is to appreciate the AmCham for this opportunity and my fellow panelists, and also to remind everybody that this country needs to create jobs. For a long time, the standard measure of growth has been GDP, but even GDP can be skewed when it comes to just from public investments. We need to create jobs. The private sector has the biggest opportunity of jobs creation, and we need to create an environment where the private sector and businesses are thriving. Thank you.
Thank you, Ken. Finally, Kenneth.
Thank you very much, Lydia. Thank you all panelists. It's been a very engaging discussion. My parting shot will be, I think government needs to focus more on broadening the tax base in a sustainable manner, instead of taxing the same people who have been paying tax all along. The focus ought to be on mechanisms and strategies to ensure that everyone is bearing their fair share of taxes. But also for all of us as well, we need to be part of the tax conversation to ensure that we are holding government to account, and we are all also aware of the tax regime and what all these changes mean for us. And it's good to see AmCham playing its role in ensuring that there's information passing across, this sensitization, and we intend to ensure that this continues to happen in the course of the year. And we'll wait for the Finance Act. Of course, we'll all submit comments. Hopefully, we'll have another session after the Act is passed into law to then discuss, what has been passed by Parliament, what has been shelved, what should be the focus for the next finance bill cycle, so that we ensure that there's consistent pressure on government to ensure that the tax regime continues to be streamlined. Thank you all, and have a good day.
Thank you, Kenneth, and thank you, panelists. It has been an absolute honor to be part of this conversation. And like I said, this is only the beginning of our engagement, and the fact that we are even seated here today discussing the bill is a good step, because it points out to our awareness of what affects us and our interest, and just contribution towards shaping the fiscal policies and laws in this country. I'd like to very much thank AmCham, you, Eva, and Maxwell as well, for inviting us and for being great hosts. And we look forward to an ongoing conversation. Let's keep talking. Thank you. Back to you, Eva.
Thank you, Lydia, and thank you, panelists, for a very edifying session. I'd like to invite our CEO, Maxwell, to give us closing remarks.
Well, thank you. Thank you very much, Eva. And panelists, this has been a fantastic session. We've ran well over the time that had been allocated for it, and I just feel like we should have allocated much more time. We should have been looking at 3 hours and not 1.5 hours. Thank you very much, Lydia, for leading this conversation. Thank you, Alice. Thank you, Patrick. Thank you, Kivindio. Thank you, Kenneth. And thank you, Ken, for really unpacking those critical issues that we need to take into consideration as we reflect on and prepare our submissions for the this Finance Bill 2022-23, 2024. So mine is just to thank each and every one of you, of our members, of our guests who joined the call today. As you can see, this is an important engagement that we want to keep right front and center because it has far-reaching impact to our lives as Kenyans, and of course to the businesses that keep driving our economy. And so with that, I want to wish everybody a wonderful day ahead and a wonderful weekend as well. So thank you and bye-bye.
Thank you.
Thank you.
Okay.